Hey there, how's it going? I'm Scott Davenport. I'm a mortgage broker out of California. I'm here answering some of the more common questions I see on the lending side of real estate. That's my dog Stan. He's over there hanging out. So today's question I get, what are points and should you pay them? This is a common question, and it's very often I have people call me all the time saying, hey, what's your best rate? And I don't want to pay points. And I say, great. I don't think you should pay points either. So points is a fee that is being charged by the bank to get a lower rate. So it's also called buy down points. 1 point is also equal to 1%. I don't know why they call it points, just call it a percent. So if they say you're charging you 1 point, they're charging you 1% of the loan. So if you had a $100,000 loan and they were charging you 1% or 1 point, you'd be charged $1,000. So what this comes into play is when you start looking at the rate buy down and how much you're actually going to get out of a discount to your monthly payment by having this payment. It's an upfront payment that's paid as part of your closing cost. It's an additional fee that's added into your closing cost to buy down the rate. Now, over the long haul, over the long term, 30 years of the loan, the buy down, you're going to see you'll end up paying less interest over the life of the loan, and you'll far exceed the cost of the points. So eventually over time, by having a lower interest rate, by paying a fee to get down to a lower interest rate, you're going to see a benefit from it. You're going to pay less overall interest. So the idea of this is, let's say you pay $1,000 or 1 point on a $100,000 mortgage, and that lowers your interest rate by maybe a half a point or so, usually about how much you see for a buy down. And that half a point of interest over a 30-year period may be worth $50,000 less of interest being charged during that time. So if that's the case, if you've paid $1,000 to save $50,000 over 30 years, that's great. But the real kicker on points is you have to think about how long. The big concern is time. The time is the true unknown factor. On average, most people are going to refinance their home every 3 to 5 years. That did stretch out a little bit longer a few years back when we saw rates dip down significantly. That moved closer to a 7-year period. But we're going into a period of time where rates are expected to come down right now. We're coming into a high interest rate environment right now that we're coming out of, and we're starting to see rates coming back down. And as rates come back down, you're going to be in a position you may want to refinance in the next 3 years, maybe even next 12 months. So when you start paying points for this transaction, you have to consider that as part of your next transaction. If it cost you $1,000 this time and another $1,000 next time, all of a sudden your recoupment period has been stretched out. If you're only saving $50 a month, how long does it take to recoup your expense? Start looking at it. Usually if it's less than 3 years, it's something I would consider. If it takes more than 3 years to recoup your monthly expense deduction from what the actual upfront payment is, then you start having to say, how long am I going to be in this home? How am I going to be in this loan? The longer you are there, of course, the more it makes sense. The shorter you're going to be in that loan or in that home particularly, don't pay points. I have some clients that are saying, hey, I'm only going to be here for 2 years and I'm going to be moving. I know for a fact this is a temporary home, but I would much rather own a home than rent. So we will actually do the opposite and get lender credits. So if you do the opposite of buying down the rate, where you're buying up the rate, take a little bit higher of a rate, the bank will actually give you lender credits to offset your closing costs, minimize your overall expenses, and make it a lower cost loan for you. And in the short term, you're going to pay just a little bit more per month for that higher interest rate, but you paid less in fees. So again, it's a balancing act. It's all about a numbers game of time, depending on how long you're going to be there, what your rate difference and the monthly payment difference is. And if you're not going to be there long enough, if you don't think you're going to keep the mortgage long enough, then paying points doesn't make sense. Right now, at the end of 2023, heading into 2024, I'm not a big fan of paying points going over for the next probably 2 years. I think we're going to see rates continue coming down. There'll be opportunities to refinance in the near future. And I like to offer most of my clients a no-point loan to minimize the cost as much as possible and find that sweet balance of still having general fees involved where you're going to have some cost but not overdo it. So that's the general idea of points. And should you pay points? The basic idea, it just depends on your situation. If you have any other questions, if you've wanted to know a little bit more about mortgage lending or financing, or looking to get pre-approved to purchase a house, or maybe you want to refinance your house, or see the numbers and see if points make sense for you, feel free to reach out to me. My name's Scott, the Home Loan Guy. Happy to help with you.